Good afternoon. This is Jonathan Satofsky of Satofsky Asset Management, June 5th, 2017, with a video blog update. Today I want to talk about one of my favorite topics of behavioral finance and how do we get people to be disciplined savers, to pay themselves first, to put away a dime of every dollar for their future selves. So why is this important? It's important because reportedly 70% of our population is expected to be dependent on Social Security and friends and charities to survive in retirement. And it's my premise that if people can put aside a dime of every dollar for their future selves, they can create a tremendous degree of abundance and self-sustainability to take care of themselves. And I haven't been seeing it for the people 60 and under. People have not been saving for their future selves. And why is it important you save and invest, candidly, is because money today will buy less tomorrow. And this is showing the example of a quart of milk cost 9 cents in 1916, and now that same 9 cents buys 7 tablespoons of milk. So the cost of goods and services rises over time, so people need to invest. The other thing to remind people is that whether people are absolutely petrified and afraid of the financial markets, the markets have worked over time. And as you can see, stocks, particularly smaller stocks, U.S. and large and smaller companies have outperformed bonds over a long period of time. And people should be investing for the long term, ignoring whatever may happen over the next week, month, quarter, year. It's not really that relevant. We have been focused on the dimensions of expected returns. We have been much more heavily focused on investing in small, cheap, and profitable companies all around the world. And this is considered evidence-based investing because it has been shown to work all around the world with great success over a long period of time. But what gets in people's way is the investor's chief problem and worst enemy is likely to be himself. This is a famous Benjamin Graham quote, and that has translated in the fact that regardless of what I buy for investors, it seems to be that the investor's timing of their deposits and withdrawals cause them to underperform virtually any asset or any investment that they own. So theoretically, when something is not doing well, they should be excited to want to buy more, and that doesn't end up happening because the pleasure-pain principle implies that the pain of losing money is twice that of the pleasure of making money. And hence, people react very emotionally to the ups and downs in the markets. And it's not really surprising that we sort of have a generation of people that are have a fear of investing in the markets because what they have seen is increased volatility. This graph shows 2% swings in market prices, and the volatility that we've seen the last 15 years has been similar to what we saw in the 30s and 40s. And you lose a generation of investors with high volatility because they can't see an extended period of calm and prosperity. Adding to that difficulty, we have information overload. With technology, we have people checking their cell phones 150 times a day, on social media two hours a day. And so it causes people, by checking information so frequently, to have more risk-averse behavior, to sell at the first sign of trouble, or to construct portfolios that are exponentially more conservative that may not get them the returns necessary to achieve their long-term goals. And this has been shown time and time in various studies. So I'll leave it on a finale of what can we do to help. We have recently, as I've mentioned several times, created a partnership with a digital technology platform in Betterment. And the reason why I'm so interested in this is predominantly around behavior. How can I motivate people to save and invest? And I find a very clever feature that they have created is something called smart deposits. And you can ask us about this, but I'll give a quick highlight. The idea that you can create a threshold of cash and reserve that you want to keep in your bank and sweep the excess for your future self, it helps. Because left to your own devices, most people that accumulate cash have analysis paralysis. They're like, well, is it a good time to invest? Is it not a good time? Should I invest now? Should I not invest now? By this setup, weekly, you're sweeping excess and you're ignoring the ups and downs and the timing, and you're tricking yourself into your future abundance. So you'll turn around in 10, 15, 20 years and say, where did all this come from? It's tremendous. So with that, have a wonderful day and a great June.